I want to say thank you to everybody today. I want to say thank you to CBRE Multifamily. I'm going to say that wrong. Okay. Capital Markets Multifamily, Burgeon Held, Mitch Multifamily, Insight Development Corp., Purpose-Built Investments, the ICBR, and we especially want to thank Ice Miller for being our host, venue sponsor, and moderator. So if we can give Ice Miller a big hand, we appreciate it. And so we're going to get our panel discussion started, and I save myself the angst of trying to introduce these guys, so I'm just going to let them introduce themselves. So Steve, if you want to get started. Sure,
thank you. My name is Steve Lamott. I'm with CBRE. I guess you'd call me a lifer. I've been there 22 years. Pushing apartment property throughout the central Midwest. And as I've told a few folks this morning, I think Connie intentionally put the apartment piece as the first segment after daylight savings time change, because we're all probably a little, maybe half asleep. So I think we could all talk about this in our sleep, the way apartments are going. So we'll endeavor to do that.
Hi, everyone. My name is Andrew Held. I'm one of the founders of Burgeon Held. We started in 2008. We own and manage about 3,000 units, mostly in Indiana, Ohio, some stuff out west too. But yeah, excited to be here and look forward to speaking.
I'm Keith Cole with Mitch Design. Work for actually partner in a architecture and interior design firm. We're also a full-line furniture dealer. We've been doing multifamily for about 13 years now. Started mostly with local developers here in central Indiana, and have the pleasure of doing work and install all over the United States. So we see a lot of different markets, and always interested to hear the finance piece. So when I glaze over up here about cap rates and things like that, yeah.
Great. Bruce Baird, I'm president of Insight Development Corporation. We're the development arm of the Indianapolis Housing Agency, and I'm probably a lifer as well in government and community development. I've been working in this industry for about 25 years, and we've been very active of the last few years, renovating our existing properties and then building new properties around them and on other sites. So we've been a major developer in the last few years and want to continue building affordable housing and other niche products in the multifamily arena.
Good morning, I'm Tyler Kolachnik. I'm a partner with Ice Miller, doing mostly bond counsel work in our municipal finance section. So I work with a lot of developers. A large portion of my practice is affordable multifamily housing. And I guess I feel Steve's pain with, but it's mostly from my children not getting on schedule yet with daylight savings time. So why don't we just go ahead and dive in? You know, we wanted to start off here with the fundamentals of how, you know, a lot of the guys here look at current markets and deals, and we're seeing a lot of, I think, generational differences and millennials wanting to live in more mobile housing or being able to not be tied down to a single family housing. So I know Steve has some information that he wanted to cite, but why don't we just go down here, especially with Steve and Andrew, and I think Keith mentioned that he has some great information, or at least can talk about some of the differences they're seeing on it from a design perspective. So.
Yeah, well, it's almost old news and not even worth mentioning just to talk about the profound shift that's occurred between single family and multifamily. Although, you know, single family is still kind of the fire that won't die. We still have single family. You talk to operators in the suburbs, and it's still the single largest reason for turnover. But the equation's changed dramatically since the last cycle, and that's probably the most profound difference between where we are in this, or I should say what the outlook is for us at this point in this cycle relative to the outlook for us at the same point in the last cycle. We just didn't see the single family debacle that was coming in the last cycle, and that's gone now, and the preferences are the fundamental root cause of that difference. The preferences are that folks, like Tyler was saying, don't want to be tied down. They want to have the flexibility. They don't want to mow their yard. They don't want to do this and that and the other. And so that's the old news part. I think one of the interesting things that isn't quantified so often because it's difficult to quantify is when you look at you look at a renter who lives in, let's say, a CBD or in a 86 and Keystone kind of location where you've got employment around you and amenities around you and it's walkable, and you've got the state-of-the-art gym inside your community, and you've got a stainless steel appliance package and granite countertops, and it goes on and on and on and on. You add all those factors together, and the cost to replace all of those in a single-family community would be significantly higher than the rent, even though the rent is for Class A multifamily product has moved up exponentially over the last several years. Because then you're adding in a gym membership, you're adding in how many dollars and miles in drive time and gas money, and you're adding in the social aspect that you just can't replace. If you're a young person wanting to be in a tight urban infill community, you just don't get that in single family. So some of these things are quantifiable and some are subjective and not quantifiable, but you roll it all together, and single family today just looks very different than what let's isolate an A-grade renter is getting today.
Can you speak to what would be the actual difference maybe in having a Class A rental property versus a single family home? Is there any information on that would show, for those people that want to live in apartment style living, that it's more expensive or is somewhat comparable to what they otherwise might choose to live in single family?
I don't know I'm sure that somebody's done those studies. We have not. I don't know what those numbers look like, and of course you can make them look like whatever you want to, because the apartment space goes from double A at $1.85 a square foot, let's say, down to C grade at 65 cents a foot. So there's an entire spectrum there, and you could make those numbers look like whatever you wanted to craft that story to say multifamily is so much more compelling than single family. But I think the reality of it is that it is. I just don't know how to connect the dots on that analysis.
Yeah, I think that's probably heavily dependent on the market too, Tyler. I think we spent a good amount of time from 2008 to 2012 really in Southern California and Arizona, Phoenix markets. I mean, like a Southern California market, it's so expensive to own single family residential that it's still a pretty good value proposition for folks to rent in those kind of markets. I'm sure that's the same for San Francisco or the East Coast markets. I think Indianapolis, there's probably a much smaller gap in a lot of the Midwest markets when folks are looking at that, should I buy, should I rent? So it's really real market dependent, but we definitely saw that even in Southern Cal, where housing is so expensive. I mean, you still see folks just really wanting to rent by choice. I think that's probably, to Steve's point, is the biggest shift, is people aren't even really considering the pricing. They're just, if you're a millennial or you're a baby boomer, you just flat out want to rent because you want the flexibility. And that's kind of a lifestyle choice that's really taken over right now.
I think it's interesting that there's always trying to be the financial connection, and because we see so many different markets, we'll get demographic studies when developers are trying to figure out what these properties are going to be. And the interesting thing about demographic studies is it's literally everybody. And so I think, what Andrew said is choice, is I think it's going to be harder and harder to put your finger on what that variable is and the whys that people are choosing to really do what they're doing today. And I think you're seeing it, we're going to talk about multifamily, but think about office space, what we heard at State of Real Estate. It's kind of make your own rules as you go anymore. So,
yeah, I'd say we're seeing similar demographic shifts as well. The demand for our affordable product is really off the charts. We're staying 97, 98, 99% leased at all times. So it's very important from our perspective that when much of the market rate is being developed, especially in the center city, but all over the city, to maintain a supply of affordable housing as well. And we're very fortunate in Indianapolis and in our market to have a strong affordable housing development community, PedCore, Merchants Affordable Housing, a great lending community, Herman and Kittle, on and on. The Witsa Group, other great groups doing affordable housing in the city. So again, I think The trend you're going to see is continued mixed income properties being developed around the city, and we're seeing it in downtown, and I think we're going to see it in other segments of the market. The transit-oriented development is going to come on strong now with the Red Line, North Meridian Street, College, down towards the University of Indianapolis campus. You're going to see trends happening in that area. So I think a number of developers are going to keep looking for those opportunities.
Okay, great. Along those lines, of course, it's great for my business to continue to see growth. But one thing I always look around in downtown and I see, new multifamily, new apartments going up everywhere. Is there at some point, do you feel like there will be a saturation or supply demand issues? We talked a little bit about, and you mentioned current vacancy rates are fantastic, but how much can be supported, really?
You want to take that, Steve, or?
I'll take first shot at that. I think it's fun to sensationalize the new supply downtown. It's unprecedented. We've never had this much supply, but I think it is sensationalized. We did a study back in the fall, and we compared Indianapolis to several peer markets, and those peer markets were Kansas City, St. Louis, Louisville, Memphis, Columbus, and of course we had to throw in Chicago and Minnie, even though they're not really peer markets. But the purpose of the study was to examine ratios of CBD residency over CBD jobs. And Indianapolis was somewhere between 4 and 5% residency to jobs. The median was 8%, and KC was the median right at 8%. So if you look at Indianapolis and you say, okay, we're a compact, walkable CBD. You've got all the sports right here in the CBD. It's clean. We've got hotel rooms. We've got the 16th largest convention center in the nation. We've got all these compelling reasons to want to be in a CBD, to live and work and hang out in a CBD. And we probably all in this room would argue we're just as good or better than most of those. Chicago and many aren't really Midwestern CBDs, but you compare us to a KC or a St. Louis or a Columbus, and I think we shine next to those. But yet we've got the lowest ratio of residency to jobs in the CBD. So if you put your optimist glasses on and you say, well, shouldn't we migrate toward the median of our peer markets? And I think we would all say, well, yeah, I think there are probably more compelling reasons to live in downtown Indy than downtown St. Louis, let's say. Then that alone will produce 6,100 new residents in the CBD if we just migrate toward the 8% median level of residents to jobs. So, what's going to bring those jobs? Of course, there need to be drivers, but I think we've got some pretty compelling job drivers and amenity drivers to suggest that might happen.
What do you see, or anybody with the continued need for mass transit, is that really going to help drive that ratio to a better point? Because right now, do you see most people are driving down, or there's some walkability, right? But we're still very much a commuter city. So
I'll let somebody else answer that question, but I'll just mention something that's kind of funny. We talked to a lot of capital sources from wherever, East Coast, West Coast, where walking 8 blocks is kind of in a day's order. And here we get in our car and we drive 3 blocks. It's kind of funny. So we talk about walkable communities and walkability to employment and amenities and Google scores, but we all still get in our cars and drive. So I think mass transit will be interesting to see how it sticks and if it comes, and we all think it's coming, and what the impact is.
Yeah, I don't know. It's the whole mass transit thing's interesting. I think about being on the side where we get to see both corporate office. We also have the multifamily piece and how they tie it together, driving business to a certain location. And we get involved in a process of saying, okay, where is this business going to go? And I think for that Midwestern mindset, and it's maybe more of a drivability versus a walkability mindset that we have right now. It's the truth. That's why maybe Indiana's maybe not the healthiest state right now, but I think the interesting thing is there's a lot of fear in moving workforce downtown. I think you've seen a lot with Salesforce, some of the California-based companies that have really been driving to downtown, and I think what's going to change that Midwestern mindset, and I think it is going to have to be a strong transit system here to drive people to want to come down. And I think there's other, I guess, factors that need to drive other than just business moving here. I think we need to be able to commute in. And so, we're definitely not oversaturated, I think, on units. I think there's a far cry for that. I know a lot of our developers are actually looking out of state, out of central Indiana right now, but I think you're seeing a lot of out-of-state developers coming in and seeing that there's still a big market gap here for what we need to have. But I think the way that we're going to have to fuel it kind of as the second run at all the units that come on down here is going to be mass transit to make the commuters come in and drive those businesses to want to come downtown and continue it.
So, I mean, it kind of leads into the next segment here. Without that component of mass transit, there seems to be, as we talked about kind of before this, three groups looking at this style of living, the millennials, workforce, and then it seems like there's a good chunk of baby boomers that are considering this style of housing now. So what does each group look for in terms of these projects? I mean, how do you see it change from niche to niche of different styles?
Well, just one thing I would say, kind of along those lines, it diverges a little bit. I think one of the goals that started under Mayor Ballard and is going to continue under Mayor Hogsett with the downtown influx of apartments and new people, I think the goal is going to be to capture those residents long term. So I think the next push that you may see is trying to, if a boomer moves down to an apartment, you want to capture them ultimately in a condo downtown, and we'd hope to see that market segment begin to grow. And then the other thing I think we're going to want to see with millennials is to also keep them in the city and keep them in Marion County. So there's going to be, I think, a major effort underway to really market the neighborhoods near downtown that have not seen much investment. The No Mean City website launched recently to really activate many neighborhoods near downtown. So I think a combination of some smaller multifamily projects, sort of enhanced for sale, single family, townhouse and other development is going to happen downtown. So I think that's a really exciting outgrowth of the downtown residential growth of multifamily.
I think the amenity space is critical, and Keith, you could probably touch on this, but it's kind of like the arms race. You see just this one-upmanship in each community, adding a tweak or a feature that's better than the last one. And then every once in a while we'll see or hear about a developer, and it's kind of anecdotal as we sit here in the Midwest. These are probably more like coastal stories where they say, no, we're not going to spend $2 million in the amenity space. We're going to put it back inside the unit where the resident wants it. And of course they want it there, but I think here in the Midwest we still see folks wanting the really rich, opulent amenity space.
When you look at developments in general, the units are, one of the biggest cost pieces. I mean, just the sheer number, when you're talking 400 plus units, there is a lot of money that is invested in there. And I think comparatively, when you talk about the amenity space and the value that's spent there is small in comparison. And I think that the reason that you don't see currently more of that put into the unit, it's a lot to spread across when you look at the unit counts. I think the other thing is it comes down to square footage. I think millennials being younger, and I'm a millennial, but I claim not to be a lot of days. And I think that there's a certain sense of entitlement that's maybe different just because of the generational separation. But I think when you look at the boomers that are choosing to be renters today, they still have maybe a hard time giving up that transition. Space is obviously a big factor in that. They're getting a lot of things, granite countertop, stainless appliances, the things that, has been on that checklist that shows the years of efforts that they put in. And I think, but there's those other types of spaces. And when you look at what's driving the programs of amenity spaces, the types of spaces that are in there, is it's, well, what did I give up in my residence? And so when you think about, the square footage that you used to have in a dining room that's really not there, and unit plans aren't really all that workable, just because of the drive of the square foot. You know, you're going to see private dining downstairs. You're starting to see spaces like maker spaces where, you know, people have given up their garages or places to kind of make it a mess and assemble things. So, you know, I think it's definitely a race on, you know, who has the nicest, but I think there's also a race in functionality of how do we get that renter there. And quite honestly, the biggest challenge right now, especially when you have as many units coming online as all cities do, there's just crane swinging everywhere when we go into a city, but it's how do you retain that resident? And I think that's the big thing that I think is the next factor in, you know, developers and property managers to figure out is how do you keep that resident there and how do you reduce your turnover?
Keith mentioned something too. There's a couple developers that I've talked to with some of the newer Class A product and what they're designing. But you mentioned kind of expectation, entitlement. I think a lot of, for the millennials, the folks coming out of college and have, you know, recently entered the job market in the last, you know, 4 or 5 years, those folks are used to living in these very, very nice, almost opulent student housing projects that have been built over the last couple of years. And so they come out of school and are looking for really something like that or better. And you know, I think that's a shift in the mindset. We've seen that. We kind of play, and we're at least going dark here real quick. That's a space that we play in, and I talked to several student housing developers that are looking to build really something similar to what they built in the student space, kind of on campus. They're trying to replicate that in areas like a downtown or like a Broad Ripple that kind of fit what those folks, the recent grads, are used to living in. And so it's kind of interesting to see how that sort of molds together and you know, bleeds over the student space into the traditional multi-space on some of the new builds.
Maybe Bruce or Keith, do you see that carry over into the affordable area? And are they looking now, the workforce type segment, looking for more of those same type of improved spaces and amenities? And since obviously only a portion of these projects are set aside for a certain percentage of AMIs, you know, does that carry over? Because, you know, you have to have, of course, equal facilities. So.
Sure, I think so. You're seeing some of that as well in the affordable product being developed. The amenities are transferring over. The unit amenities, as you speak to, are also transferring into those units. I think one of the interesting things to note as well on the whole question of parking spaces and mass transit and so on, it's interesting to see developers be able to now make that decision about what to provide and how much to provide. The zoning code just got an overhaul in Indianapolis, Marion County, and I think you're seeing this as a trend in other cities as well, is to not dictate garages, excuse me, or acres of parking. It's to let each development determine what that's going to need. We just built our Milliken on Mass development with 0 parking. But and it's leasing up well, and the retail's leased up well, and I think there's now an understanding that the parking can be obtained, and we're going to get away from a sea of parking lots around urban developments and even suburban developments. I think it's gotten a lot tighter as well, and I think that bodes well ultimately for development. And for the rest of the amenities, I think you'll always see probably, you know, not so grand on the common space and the pools. Some of those things are even restricted by the funding, but I think you'll also see very good design, well-designed sites, and that's going to be the expectation from an affordable renter as well as a market rate renter.
I think even so, we spend quite a bit of time in the workforce space, but more suburban. So, you know, sort of the around the donut type suburbs, your typical 30, 40-year-old, sometimes garden style apartment project that's really hasn't had a lot of capital sunk into it. But for even those projects where the renter on the workforce side is much more sensitive to big moves in pricing, we still will go in and do rehabs to the clubhouse to a lot of the amenity, and focus on the amenity side for the site, not just the unit. I mean, we'll spend the bulk of the time on the units, but we allocate a good chunk of capital to the amenity side just because it's what folks expect now, and that's even projects where you can't drive these huge rent bumps. They're pretty moderate just because the renter won't accept it. But even those projects.
What would be the average per unit capital that you're putting in for those kind of upgrades?
We would probably spend, on a typical unit, it's between $5,000 and $8,000. So you're looking at redoing kitchens, floors, bathrooms, fixtures. So they're getting a pretty good facelift, and then we'll spend, call it a 200 unit project, we'll spend $750,000 to $1 million in exterior improvements. So just really giving it a good facelift, and I think ultimately the result of all this, you're going to get, it's kind of you got these two pockets of the market. You got this millennial boomer piece that's focused on the Class A product, and then you've got this workforce piece that's much more price sensitive, that's not living in this AA type product, and I think that's a segment that's really, really growing, and that you're seeing time and again developers, acquisition groups coming in, buying those older projects, giving them a facelift. The ultimate result is, I think we're going to have great housing throughout Indianapolis and really across the country because those two things are happening.
I think, one of the things Steve had mentioned when we talked is there's been and maybe you've seen it too, Andrew, but there's been a good influx of out-of-state capital and even developers that are now looking at Indianapolis. And when you mentioned earlier, comparisons to Columbus, Kansas City, I mean, what do you think is now more attractive about Indianapolis versus, a couple of years ago, 3-4 years ago?
Well, I think an even better story is we got guys like Held and Burge who are here in town buying multifamily, which has been a shift. We've had just a handful of local operators who have been active in the acquisition space over the last 20 years, like literally a handful. And now, Andrew, you're up to, what are you up to, 4,000?
Maybe we'll be up to 4,000.
4,000 units?
In a couple months.
In a pretty short period of time. So that's a pretty impressive feat to accomplish in this environment as competitive as it is on the acquisition side. But I think to answer your question, Tyler, it's pricing, it's return. When Seattle's trading at a 3.5 cap routinely for Class A product, a 5.5 in Indianapolis looks pretty good. So it's return in a large part, it's stability, it's diversification. We talk about Indy being a flyover market 10 years ago, 20 years ago, and people couldn't find Indy on a map, and it was really hard to sell Indianapolis. And today, that's just not the case. Now, it's not an institutional market. We don't have 20 institutions bidding on a Class A property here, but we have a few, or we have 5, and that's a big shift. So it's a nice augmentation to what's otherwise a very private capital type of market.
And Andrew, you said previously that there have been, you've had some bids obviously that didn't get picked up. What, is that usually when you have an acquisition, is that from a previously out-of-state owned property? Do you find it's 50-50, people that, or developers locally that have owned the property and are just looking to sell at this point?
Yeah, it's a mix. I mean, I think you find a mix of out-of-state owners and local groups that are looking to sell as well. I think, to Steve's point, I mean, Indy still is a private capital market. You don't have the big REITs from the coast coming in and buying yet. You might see it. He could probably speak better to that, but you have now, though, some of the funds that have been raised that on the coast that are coming in to the market, and Steve mentioned you're ultimately chasing yield, so you're moving out of 3-4 cap markets into 5-6 cap markets. So ultimately those guys are, if you're a fund, if you're a REIT, whatever, you're driven by the yield, and so they're going to chase the yield until basically it goes away, or they hit a squeal point from a risk perspective. But we've been successful, I think, because we brought in coastal capital, but we also have local capital and sort of blended that together, have been able to provide a better yield than I think what they can get elsewhere as the ultimate driver for it. But you'll see all sorts of sellers. We buy stuff from families that have owned a property for 25 years, or we're buying it from a very, very sophisticated group that's owned it for exactly 7 years, right when they penciled it to sell, and now's the time to sell it and close out their fund and move on to the next. So it's a wide range that you run into out there, and they're all kind of different.
Yeah, from a bond perspective, we've definitely seen maybe not the big players from the coast, but more so out-of-state developers coming in, picking up products that are typically had been locally owned. And so, to some extent, I think it translates from your side of the market into ours, or maybe one's a leader, but they're definitely utilizing and even just buying around the state, not necessarily just Indianapolis. So
I think too, and you got a segment as well between the product that people are buying. I don't know of a deal recently, and we have not won a Class A deal, nor do we even attempt to bid on it. So those are deals that I think, Steve can speak to this better, but I think those are going exclusively to out-of-state buyers, groups with much bigger capital than certainly we have. We're more in the B and C space, but I think the A deals pretty much will go to out-of-state groups.
Yeah, that's true. Yeah, the A deals, the more aggressively priced deals go to the aggressive capital, and the aggressive capital usually comes from outside the market, and it's different motivations. It's somebody in a 1031. It's somebody a group trying to close out a fund, and they've got to cram one more property or two more properties into the fund before they can blast it off and syndicate it. So it's different motivations for different groups. Andrew, you mentioned risk a few minutes ago. I think that's one of the interesting things to look at where we are in this cycle. And of course, real estate investing is a risky proposition. It's a hard asset, but there's risk involved. It's an operating business, and you need to get paid for that risk that you take on. This is one of Andrew's favorite slides. We show this slide and update it each year on the risk premium that we see in the market today for Class A and B multifamily. Normally, I'd like to have a screen back here behind me with 150 slides that I can flip through and use as my crutch, but Connie said no visuals today, so I'm just going to have to try to verbalize it to you. But if you can think back to the end of the last cycle, so call it 06, 07, the risk premium, so the spread between return that the asset's producing and let's take it this way, the spread between the cap rate and U.S. Treasury, that spread became extremely narrow. Like it was 150 basis points for AB product here in Indianapolis, and in other parts of the country there was no premium, there was no risk premium, so you were effectively not being paid for the risk that you were taking on in operating apartment property. That spread blew up to 450 or more basis points in the recession, and it stayed around that level for the first several years of recovery. Now it's exactly, we just ran this number last night, 381 basis points. As you look at all of the 2015 AB trades, we rolled them all together. They all traded at a 576 cap, blended among the whole batch of them. So that spread is 381 basis points. The 10 years trading below 2% today. So there's still a pretty thick spread risk premium in place today that I think will sustain us as we see some interest rate movement, upward interest rate movement, that is, over the next, we could say several weeks, but maybe it's several years, who knows at this point. The point is we'll see rates move up, but there's a lot of fat there in the risk return that we think will allow for some absorption of interest rate movement before we see prices start tapering down, which is not what guys like Andrew want to hear as he's trying to go out and be competitive and buy. But I think that's probably the reality of where we are.
Yeah, I think each year we kind of look at it, and I kind of go into it, well, are we going to do one deal this year? Because of how the cap rates have compressed and where the pricing's at, you look at it and think, gosh, I don't know if there's one deal that can work anymore. Because we're ultimately a private capital group, but we're the most expensive equity out there, as compared to some of the funds and the REITs. So a lot of the deals they just flat out don't work. But when you look at it, when you're kind of baking the cake and putting the deal together, there is still yield, and you can, with today's debt, which we'll get into that, I think, but with today's debt markets for the multifamily space, you can still generate good yields on these projects if you do them the right way. So I think when that goes away, I think that'll push private capital guys like us out, and it'll just be time for some of the bigger groups to play, and then maybe it'll adjust. But right now, as Steve mentions, it's a pretty good proposition when you're looking at that kind of spread over the 10 years. So the risk-free rate, a 6% yield doesn't look too bad when compared to 1.8%. So.
And that's not even taking into account interest-only financing, which is available just for raising your hand and asking for it. And it's 2 years, just almost as an automatic.
Well, yeah, let's go ahead. I mean, I'm glad you guys touched on kind of the capital markets piece here. So, I know, Andrew, I think you said, of course, that the private piece is a big part of what you do, but did you say 223Fs or another part of your lending strategy?
Yeah, no, we use the 223F, which is the HUD FHA market rate vehicle, and then you can also layer on some rehab components to it, which it's fantastic debt. I think it's some of the best debt in the whole world. That, along with Fannie, Freddie, CMBS, and then the traditional commercial banks, you've really got an unbelievable cadre of debt options for multifamily now that really doesn't exist. So you think about FHA, Fannie, Freddie. I mean, those are only there for multifamily, and they serve a purpose. The U.S. government feels like there's an important need and important to keep liquidity open for affordable housing mainly. So those vehicles are really unbelievable, and as long as those stay out there, there's going to be good liquidity in the multi-market. As opposed to the commercial side, a retail, industrial, office, you've got really life companies, CMBS, and bank debt out there. So really anybody in the commercial or apartment space looking for financing, if you can't find it, you need to kick that deal to the curb, because there's plenty of debt out there to be had, and it's great financing.
And I mean, what restrictions go along with that type of debt that you could speak to, if at all? I mean, covenants that you'd like to see changed, or words of warning, anything like that?
I saw some PR mortgage folks out here. They could probably speak the best to it, but
friendly lending community is
right. We
said.
we have a great lending community. We have a great real estate community. It's really about as easy a place to do business as you could have. But on the FHA side, I think they've made some really good changes recently to the MAP guidelines that have helped lower the reserve requirements. That's where you get stung, as the upfront reserve requirements. On the physical side for the assets and some of the ongoing reserve requirements. They've adjusted those recently for the HUD financing, which is great. I think it puts it more in line with a Fannie Freddie type product when you're looking at the reserves and the upfront capital. I mean, the other piece for the HUD deals is you're restricted to 2 times per year to distribute cash out. So that's a piece that a lot of folks struggle with, a lot of our capital partners struggle with. What else? The React piece is fine. Those are the every couple of years you have to, the HUD comes in and it'll inspect your property, give you a score. If you're below a certain score, you got to do X, Y, Z. So that piece is fine. I think in terms of the debt itself, what you have to do once you're in the loan, FHA is certainly, I think, the toughest. Fannie, Freddie are a little easier to deal with. The HUD piece is tricky because you've got interest rate risk, right? There's no, unless I can wrestle Steve to the ground and say, hey, I need 6 months to close this deal, which no seller in their right mind is going to give us time to do. You can't close with a HUD loan, so you've got to finance it a different way, put a bridge loan in place to acquire it, and then roll into a HUD product. So you've got interest rate risk during that period, so that makes the underwriting a little challenging. Fannie, Freddie, you can lock the rate at closing, so you're locked in. Same with CMBS. So I don't know. I could bore everybody to death talking about that.
Well,
I think you hit the highlights, but there are a couple things that relate to the transaction side that I'll mention with respect to HUD. HUD's probably the best tool for a long-term owner, and that's why I'm trying to convert Andrew to more of a short-term lender mentality, so we can move him into a seller category. But he's content to amass product today and grow his portfolio, and HUD's probably the best way to do that. But on the transaction side, the groups that we sell to largely are traders. They're in and out in not necessarily 18 months or 3 years, but let's say 3 to 5 years, or maybe 5 to 7 years. And HUD is great for a long-term owner. You've got a 35-year amortization or a 40-year if you're doing a D4. So it's just a totally different mindset. It's long-term versus active trader. And the traders don't really like the HUD proposition. It just doesn't do anything for them. One of the big reasons is, as Andrew mentioned, the semi-annual distributions. Most of these groups are syndicating money. You can stick that label on it, whatever the nuance is to it. It's still a syndication model, and they need to pay quarterly or at least semi-annual distributions, but typically quarterly, and maybe sometimes more frequent than that. So the HUD model just doesn't work for those groups. They can't pay those dividends in the timely fashion that most of the investment capital would like to see.
Bruce, is there anything you want to
Just,
jump in
the space that the affordable developers and owners live in, the REACT world and the highly regulated world is something that we're accustomed to, and that's huge. And I know it does, when you do accept the HUD financing, you step into that to a certain extent. So we know that world very well, and you know it well with your clients as well, that it's a huge part of our lives and our work.
What do you usually, on your deals, pair? I mean, I know it's a large portion, 9%. Where's the other debt piece coming from?
We've been, just for us personally, we've been able to structure most everything without any permanent debt. So we've only had construction period debt, and that's come from local banks, but we've built nearly everything without any permanent debt.
Well, I guess, I don't know if we've spent too much time on capital markets. Certainly we've seen that capital partners are viewing Indianapolis as more favorable. So Steve, thanks for that insight. I want to move on to the new supply that we've talked about a little bit, but it's kind of a question of where will this financing be used and where are we going to see the new developments in town. And I know there, obviously you guys mentioned some developments out of town that perhaps we'll see here in the future. So, did you mention, I think the new supply would be branching out into the neighborhoods, and how do you see that happening? What tools do you think are best suited for that?
And maybe even an add-on to that too, and an add-on to some of this discussion is increased construction costs and what factor that's going to play. And I'm sure you're seeing it across the board with such a huge amount of work going on right now. I think we're seeing those increase pretty dramatically, and maybe you speak to that as well, because that's such a huge factor right now about new starts and new product coming online, how that's going to have an impact.
I know we've seen some interesting deals, and obviously there's a lot of discussion on Market 360, being the other than the hotel that came up. The first one to really change the skyline, or will change the skyline, for about 20 years here. And it's interesting hearing conversations from the construction side, and it's not just multifamily, it's really all the industry here. And price is definitely driven. Everybody's busy here in town, and it's been, for a lot of our clients, been pretty significant. The other interesting thing beyond just the finance side is people finding labor to actually build. I know that there was conversations where, there's so much going on in every segment. It's almost hard to get one company to respond to a bid, and so there's a lot of scrambling and searching to even get product built at this point in time. So, and I don't think that our market's really any different. Whether it's one of the states here, we were in Toronto. Toronto's probably building more condos than apartments, which is interesting. I think it's a noticeable difference maybe in the way that the markets are set, but just because condo really hasn't done well here, and I don't know what to speculate for the future and how that changeover happens, but literally every city you go to is just pulled for construction folks. And so I don't think anybody's going to slow down anytime soon, and I think you're going to see costs continue to rise over probably the next couple of years, quite honestly. So
I believe you just because you have a bow tie on. Makes you smart.
I try. That if that's all I have, I can't really talk about cap and stuff, so compensate for other things, I guess.
I'd reiterate that. We have a small construction group just doing really light rehabs, nothing to the scale that gets built downtown or on the north side. But we struggle to find good labor. It's a real challenge right now. I think you're just going to see that more and more, that it gets more and more expensive.
Just because everybody's so tied up right now?
Yeah, absolutely. Everybody's so busy, which is a great thing. It's great for the economy. It's great for all the different groups. But it's a challenge to find good folks on the construction side right now.
Yeah, definitely there's been a growth. You've seen it with the Whitsitt Group coming on with TWG Construction. So maybe that's a trend that you think will continue with developers actually, just bidding on the construction side of things.
Yeah, no, I think there's a good gap there. There's a couple groups. Chris Reed does a fantastic job. And really builds for pretty much everybody that doesn't have it in-house. I think a lot of the groups, most of the multifamily developers have their own in-house construction, so they're kind of just kind of feeding themselves. Whitsitt doing outside third party, absolutely. I think it's a great idea. I think there's probably a void of that right now. There's between Whitsitt and Chris, there's a couple others, but really that's it right now in our market.
Obviously they play in more of the general construction. It really comes down to availability of skilled tradespeople. So you'll see, everybody would love to manage and pull that piece in from a construction standpoint. It's just, there for a while you were seeing a lot of out-of-town contractors coming in to build large projects here, and they're just pulled away and where they're really centralized. So it's resource. That's what it comes down to. So
great. And you've got to find people, right, with the HUDs that are versed in Davis-Bacon and all the requirements that come along with that, and same with the 9%, 4% deals. I guess I want to go back real quick, Bruce, with, you've obviously been pretty successful, like you said, without having to fund with debt, but for a long time, there were no any tax credit deals really getting done that we saw. So it seemed like the 4% kind of came back first, and then the 9% deals. So, what's been your experience? Did you see that same gap with your deals? I know the traditional logic is that 9% don't necessarily work as a 4% deal. So during that period of time, after 07, 08, did you have to find other ways to fill that that gap?
Yeah, we did, and we made it through that period, and as you know, today yields are way back up, and the credits are very much in demand. So they're very much in demand to get the allocations. That's a hard scrabble fight every round this year, and really in this state and in other states. So I think it is starting to drive more developers to the 4% side and try to figure out ways to make those work. We have a 4% deal in the works. It'll be our first. And then I know a number of them are coming down the pipeline. And I think you're going to see more of that. And I think with the huge Class A development that's happening, there still is that need for workforce and below for the very low income renter. And we've got to keep that in balance. So I think we do it very well in Indianapolis overall, that we have a good balance of the high end, the workforce, the senior, and the very low income with public housing, and we've made an effort to keep public housing in great condition because there's such a need there as well.
Right. And maybe Steve and Keith and I don't know, Bruce as well, but we've seen a little bit of move towards boom, or not, definitely more deals in the past now that are considered more supportive living, both for seniors. I know Bruce mentioned earlier when we were talking on the more kind of transitional side, but is that something that the aging population, have you seen that coming into the market, proposed deals or acquisitions that may be supportive living style housing?
Yeah, I think you look at the senior housing industry and it's evolved just like student housing did 15 years ago. And I think it's still evolving. You look at the baby boomer segment alone, which doesn't need that supportive housing yet, but will in another 20 years. I think the evolution curve will continue for the next couple of decades, probably in that space. And there were periods over the last several years when you can remember looking around and you see a new senior facility being built on every other street corner. It's got a new facility, and you think, wow, is the market oversaturated with senior housing? But you look back at the demographics, and I think it's hard to make that argument that it is oversaturated at this point.
Yeah, I think it's been interesting from a developmental and maybe progressive standpoint, what Main Street's been up to. I think they've really done a lot to change really across the United States what senior care is going to be. And I think, when you look at what's happened from student transition into apartments, you're also kind of seeing those people that maybe are a little bit more in denial of needing to go into an assisted facility that maybe don't quite need skilled care at this point, and they're making the decision, well, they can't take care of their home, they're going to backfill in, and I think you're going to see a little bit of deferment of people going into more of an assisted living or a independent living type facility, because there's a little bit of a connotation, I think, from a pride standpoint, but I think you're seeing those pieces grow together, especially when you do look at Main Street's product. And it's interesting you talk about, the perceived surplus that's here. And, obviously there was a moratorium put on for new facilities. But, the interesting thing is a lot of the age facilities, especially from the senior care standpoint, aren't getting the care that the age apartments are in our industry. And I think that gap, as far as the need of a quality solution, and I think the unfortunate piece, and my wife actually works in senior care, you're starting to see workforce and quality workforce not to want to go to those facilities just because of the quality of the facility, and I think it relates to also the quality of the people and the quality of the care that gives. So I think you're going to see some of those older communities start to lose population, and so there's going to be a gap, and I'm not quite sure what's going to happen in that market. My hope is somebody's going to come in and realize what's happening with apartment communities and start buying those old properties and getting them turned around. So
I think it's interesting to take a step back and look at apartment development as a whole. And if you go back 20 years ago and you look at new construction maps of where it was built, it was like somebody taking a shotgun blast to the map. It was just everywhere. It's like in the middle of a cornfield over here, and there's one over here in Hancock County, and then you got one down here, and you think, now you look back on that and think, what in the world were people thinking building in the middle of nowhere with no amenities, no employment and so forth? But that was the development model 20 years ago. And today you look at development, and I call it intelligent development today. It's very well placed. It's strategically located next to employment centers, next to amenity centers, next to roadways, and just reflects the changing needs and preferences of today's renter. And I think it bodes well for absorption and for being optimistic about the future of fundamentals in a city like Indianapolis, when we've got a fair amount of multifamily product being built. It's being built where people are and where they want to be today.
I think too, one thing we talked about earlier at breakfast was, to Steve's point as well, is Indianapolis has got an unbelievable amount of great developers. I mean, very different from a lot of cities in the country. So we're very fortunate on that side, I think, and our downtown shows it. I think how Carmel and the north side has developed it, I think shows it. I mean, you've got we could sit up here and name names, but these folks, the Millhouses, the Flahertys, the Harts, the Whitsits, Pedcore, you go on and on with all these different groups. I mean, they're fantastic developers, not just in Indianapolis, but across the country. I mean, these groups are all over, and it's neat to see, because I think that all of them have projects downtown, and I think now our downtown really reflects how good they are, and I think it's going to continue to grow and be something really great. But we're really fortunate. We have a great stable of developers here that compare fantastic nationally.
We just need them to stop hoarding their product.
Can't help that. I think we're about out of time, but is there any, maybe give you guys a chance to talk about any current transaction? I was interested to hear about Bruce's supportive living project and how that came together and current operation.
Yeah, sure. Just very briefly, we just built, and we run the gamut from a market rate building with retail to public housing to affordable housing, but we just finished a 38-unit supportive housing development on Pennsylvania Avenue that is full supportive services for homeless people, and there's no other criteria to live there other than you are homeless. So that's very important to the city as well, and I'm really excited that we finished that. It's a model that's been in place in a number of cities and is just vitally important for our city to deal with that population.
Yeah. That's a great project. Thank you. Anybody else would want to real quick just touch on?
I won't necessarily mention a transaction, but I think it's kind of interesting as we cap things off here to look at what the capital markets are saying. I mean, where are we in the cycle? Are we in the 5th inning? Are we in the 7th inning? I think most would say we're probably somewhere plus or minus 7th inning, but there's some schizophrenia in the market. When you look at the market as a whole, the capital markets as a whole in the transaction space, there's this voracious appetite still to place capital. The need to invest in multifamily and commercial real estate in general has not gone away. It won't go away. So that capital has to continue to be put out in large volumes. Yet, on the other hand, we're hearing groups talk in specific conversations, hearing groups talk about today's pricing, and do I really want to be at $150 a door in a suburban property at this point in the cycle? And that's the important part. They're saying things like at this point in the cycle. So there's some acknowledgement that that we're something's going to change at some point. I don't think it'll be an abrupt end like it was in the last cycle, but something will change. And in the meantime, though, it's full throttle, and groups are just clamoring to get control of product.